Well, there you have it, ladies and gentlemen. Gold and silver are back in the news, with gold ending the week at 1864 and silver ending the week at 2530. You know the main catalyst. It was in the news this whole week. It's all about inflation. And funny enough, in this episode, we're going to be talking about the forecasting model that I actually made on inflation. So you guys know I made forecasting models on gold and silver, but I did it specifically for CPI. So this can be a way for us to gauge how gold and silver may react relative to CPI. So I'm about to show you that. But before we get into that, please hit that subscribe button down below, because you get certain things from this channel regarding gold and silver, precious metals, inflation, the economy, that you won't get anywhere else. The main reason why is because I actually use statistical analysis to figure out where we could be heading. Now, also hit that like button to get this video out there. So this is essentially what I tweeted out yesterday. And for those of you who aren't following me on Twitter, just type in investing with TJ into the search bar and you'll find me. So I spent about 3 hours creating a CPI forecasting model. The reason why is because I was actually waiting for a plane. I was doing some traveling. I was in Denver. And I was like, you know what, let me just create this thing, because everybody's talking about CPI. I want to see if I can actually create a model that'll, anticipate things. So my model basically looks ahead 2 months in advance to figure out where CPI could be. And essentially, the upper limit for November was 16.6, central 12.06, lower limit 7.52. Mind you, we just got the October numbers. So this would be what we'll get, which will be announced in December, mid-December, of what the November inflation numbers would be. This is my estimation, and this is the whole range. I am more so lean towards this lower number of 7.52, just given the fact that we came from a 6.2% CPI read for October. And here are the stats. We have descriptive statistics, and we also have inferential. And with a 2-month lead in correlation with the actual observation, I'm at a 0.98 correlation here with the actual observation that we get for CPI. R squared, the coefficient of determination, 0.97, adjusted R squared, 0.97. So it's pretty tight as far as what we see with descriptive statistics. Now, inferential, things are looking pretty good as well. Long story short, standard error isn't too far off. Multiply that with the t statistic, and then we can use this to create a nice band. And that's how I get the lower number and the upper number, by adding and subtracting it from the central number. So that lower number is the central number minus this number, and it gives me 7.52% essentially. So long story short, if we get 7.52% CPI, we will not hear the end of it. People will be freaking out. Just think about it. It'll be during the holiday season, and people will just be thinking, well, I have to buy all these gifts for my friends and family. This is insane. People are going to be freaking out if this actually is what we will get for November. Now, mind you, I created this by using 3 inputs that predict the 3 largest components of CPI. So the 3 largest are housing, you got shelter, you got transportation, you got food and beverage. So this is predicting headline inflation. Now, here's the thing. The 5-year break-even inflation rate has been rising to levels that we have not seen even on record. So 3.11 is what we're expecting for the 5-year break-even inflation rate. And it's just been rising aggressively over the last several days. So inflation is definitely the talk of the town right now. And even the S word is starting to pop its head up, with people talking about stagflation. Now, regarding stagflation, I do think that we have the setup for it. The one thing that I would need to see for it would be if the unemployment rate actually starts to rise as opposed to continue falling, because the unemployment rate is actually getting close to where we should be, which is the non-cyclical rate of unemployment. So we should be at 4.27, but we are currently at 4.6, which honestly isn't too far away. Now, if we start to see, businesses firing people, or if, we start to see, um, you know, the number of people who weren't interested in looking for a job starting to look for jobs at a higher rate moving forward, then we might see that unemployment rate number increase. Because funny enough, we've actually been seeing that one of the reasons why the labor force has actually been decreasing so aggressively during 2020 is that a lot of people who are baby boomers have actually just decided to retire early. It's one of those reports that came out recently. So pretty interesting to note. But if the cost of living is, crazier than what was anticipated, we might start to see those people enter the labor force again, which would increase that unemployment rate to the upside. So that would be something I am going to be kind of clocking on in the background. I won't be talking about it too much unless it starts to rear its ugly head. But long story short, inflation is going to be an issue. Stagflation, could be around the corner, but we just need to see certain things play out. But long story short, gold and silver are going to be benefiting in this environment of we are seeing lower aggregate output as the stock market is anticipating, and we're going to be having higher rates of inflation. So those of you who have gold and silver, I'm sure you guys are happy campers. Definitely let me know what you think regarding this past week of pretty much nonstop talk about inflation. Let me know what you think about it in the comment section. Hit that subscribe button. Definitely follow me on Twitter, and let's see what this ride is going to be like heading into 2022.